Welcome to the TAC Index AI podcast. We're the place where we blend TAC IP data, reports, and charts with the latest news in logistics, focusing especially on air cargo.
And today, we're diving into the latest air freight market data from TAC Index.
Yeah, we want to really unpack what it means for global logistics and even the wider economy. We'll look at, jet fuel costs, capacity, and those shifting trade dynamics.
It's definitely a market of contrast right now. If you look at the Baltic Air Freight Index, the BAI 0, that's the global picture, it was pretty flat last week, dipped just 0.1%.
Okay, stable sounds good.
Well, yes and no. Week on week, stable. But year on year, it's actually down 5.0%. And that overall stability, it's really masking some pretty significant moves underneath, regionally speaking. Big changes in how logistics networks are even being set up.
Right, stability hiding dynamism.
Yeah.
So Europe seems to be a bright spot. Frankfurt's BAI 20, that's outbound, jumped 7% week on week, almost 8% year on year.
Exactly. And London Heathrow, BAI 40, was up 7.8% week on week and, get this, over 25% year on year.
25%. Wow. What's driving that strength in Europe, do you think? Is it just demand?
It suggests pretty robust demand, yeah, and maybe less immediate capacity pressure compared to other regions. But then you look at Asia and it's more nuanced.
Okay.
Hong Kong, BAI 30, dipped slightly, 0.3% week on week. Shanghai, BAI 80, down about 1.3%. But the really interesting story might be India.
India. What's happening there?
Rates gained going into Europe but fell towards the U.S., and that fall to the U.S. came right after those 50% tariffs on many Indian goods were announced.
Okay, so a direct tariff impact visible in the rates.
Absolutely. Taiwan showed a similar pattern, gains to Europe, falls to the U.S. It really highlights how tariffs aren't just a cost anymore. They're actively causing shippers to reroute entire supply chains. It's fundamentally shifting demand lane by lane.
And I suppose the U.S. side reflects that too. Rates out of the U.S. mostly lower, you said? Chicago, BAI 50, took a big hit, didn't it?
Yeah, down almost 12% week on week, over 18% year on year. It's a clear sign of how, geopolitics and trade policy changes ripple through air cargo rates almost immediately.
So August looked like a holding pattern overall. BANI up just 1.2% over the 4 weeks.
Yeah.
But you're saying there's a lot churning beneath that surface.
Definitely. We're seeing significant shifts in demand patterns. E-commerce, for instance, seems to be moving away from the classic trans-Pacific routes.
Oh, interesting. Where's it going instead?
Towards Europe, the UK, South America, the Middle East, Africa. And it's not just e-commerce. We're seeing more activity in garments, pharma, electronics, semiconductors, too.
And all that shifting demand must be putting pressure on capacity in these new hotspots.
Exactly. We're hearing reports that freighter and belly hold capacity are pretty much full on some of these key lanes now.
Which gives the carriers more leverage, I imagine.
Yeah.
Especially for longer-term deals.
It does. And it's leading to bottlenecks. Southeast Asian hubs, Bangkok, Singapore, KL, seeing transshipment congestion, causing delays of like 7 to 12 days.
Wow, that's significant.
Yeah, and Africa is facing maybe 6 to 9 day delays just because freighter options are limited. It's getting tight out there in specific spots.
Okay, so capacity is tight. Carriers have more power. But what about their costs? You mentioned jet fuel earlier.
Right, and this is where it gets really interesting, almost a paradox. Platts data shows jet fuel rates actually dipped 4.3% in August. And year on year, they're down over 10%.
Down 10%. So even if air freight rates are generally falling or stable,
carrier margins could actually be just as high, maybe even higher, because their biggest variable cost, fuel, is significantly cheaper.
That's a crucial point. It changes how you think about carrier pricing strategy, doesn't it? They might have more room to hold firm on rates, even with fluctuating demand.
Precisely. It gives them leverage heading into peak season negotiations. Shippers need to be aware of that dynamic.
And all these market shifts, they don't happen in isolation, right? What about the bigger macro picture, the economy, politics?
Huge factors. Markets are watching for U.S. CPI data. There's an expectation, pretty much priced in, that the Fed will cut rates next week, maybe 25 basis points. Driven partly by that unexpected drop in U.S. factory gate prices.
And President Trump's pressure on the Fed over rates continues. That adds another layer of uncertainty.
It does. Any big shifts there could hit borrowing costs, consumer demand, and ultimately cargo volumes. And then there's geopolitics.
Like the situation with Russian drones near Polish airspace.
Yeah, events like that raise tensions, could lead to more U.S. restrictions on Russian energy, which, could eventually ripple back into fuel costs, despite the current dip.
And President Trump has also mentioned potentially adding new tariffs on India and China, linking it to pressuring Russia over Ukraine.
Right, contingent on the EU playing along. It just adds more complexity, more potential disruption to trade routes that rely on goods from China and India, who happen to be big buyers of Russian oil.
It's a complex web. And meanwhile, the U.S. dollar, while steady, is seeing its share of global reserves slowly shrink.
hmm And you see growing interest in alternatives like gold, crypto. That whole financial landscape influences global trade flows, too.
So the air cargo market looks like it's in a holding pattern on the surface, but really it's reflecting all these massive shifts in trade, politics, economic policy.
Absolutely. It underscores how vital adaptability and flexibility are for supply chains right now, especially heading into peak season.
Which leads us to our final thought for you today. Considering this mix, the shifting tariffs, the energy politics, the changing currency dynamics, how might these big macro trends fundamentally redefine both the risks and the opportunities for global logistics players over, say, the next 12 to 18 months?